Hi, welcome and thank you for joining us for today's outreach seminar titled Regulatory Filings. My name is Matthew Kung, and I am an accountant within the Registration, Inspections, and Examinations Division of the OSC. Today I am joined by my three colleagues from the same division: David Tong, Senior Accountant from the Data Strategy and Risk Team, George Roden, Senior Accountant from the Regulated Entities and SRO Team, and Rachel Yu, Accountant from the Investment Fund Manager Team. Please note that the views expressed in this presentation are the personal views of the presenting staff and do not necessarily represent the views of the Ontario Securities Commission or any of its other staff. This presentation is provided for general information purposes only and does not constitute legal or accounting advice. Information has been summarized and paraphrased for presentation purposes. The examples are based on assumptions not necessarily outlined in this presentation and are provided for illustration purposes only. Information in this presentation reflects securities legislation and other relevant standards that are in effect as of the date of this presentation. The contents of this presentation should not be modified without the express written permission of the presenters. We have several topics to cover today. David Tong, Senior Accountant from the Data Strategy and Risk Team, will discuss participation fees, followed by George Roden, Senior Accountant from the Regulated Entities and SRO Team, who will discuss excess working capital, and followed by Rachel Yu, Accountant from the Investment Fund Manager Team, who will discuss NAV adjustment reporting. The Q&A portion will commence afterwards. And with that, I will pass it along to my colleague David, who will present the first topic.
Thanks, Matthew. Before we start, we'd like to ask everyone to please submit your questions as they arise using the question function in the GoToWebinar control panel, rather than waiting until the end of the presentation. And with that, we'd like to begin by providing a brief overview of the capital markets participation fee under OSC Rule 13502. The capital markets participation fees are the annual fees paid by registrant firms and certain unregistered capital markets participants. The fees are designed to cover the Commission's costs not easily attributable to specific regulatory activities and are based on a measure of the firm's size. In other words, its specified Ontario revenues, which is used as a proxy for its proportionate participation in Ontario's capital markets. The calculation follows an increasing tiered structure set out in Appendix C of Rule 13502 that is based on the firm's reported specified Ontario revenues. The higher the specified Ontario revenues reported, the higher the fee payable in the applicable tier. Over the next few slides, I'll cover who pays the fee, what needs to be filed, and when, and then we'll walk through the calculation line by line, highlighting common errors and how to avoid them. So who exactly is required to pay these fees each year? There are two broad groups in scope for participation fees. The first are firms who are registered under the Securities Act and/or Commodity Futures Act in a category of advisor, dealer, or investment fund manager. The second are unregistered capital markets participants, which include exempt international firms relying on the international dealer or advisor exemptions in National Instrument 31103, unregistered investment fund managers that rely on the permitted clients exemption in Multilateral Instrument 32102, and funding portals relying on the startup crowdfunding registration exemption. If your firm falls into any of these two groups, you're expected to complete the annual calculation and pay the fee. Now let's look at the timelines, form, and late fee framework. Each year, firms must complete Form 13502F4 or Form 13503F1 before November 2nd and pay the participation fee by December 31st. If your firm pays through NRD and the form is filed, the fee you calculated will be drawn automatically from your registered bank account on December 31st. EFT exempt firms should submit payment by check or wire using the instructions provided by the reminder email sent earlier in September. In terms of late fees, there's two regimes to be aware of. If Form 13502F4 or Form 13503F1 is filed on or after November 2nd, a late fee of $100 per calendar day will be charged, subject to an annual cap of $5,000. If the participation fee is paid after December 31st, an uncapped late fee of 0.1% of the unpaid amount per day will be charged. Please note that the late payment charge for unpaid participation fees also applies if a prior year underpayment is later identified, whether self-disclosed or found by staff. To avoid these fees, please ensure your filings are made on time and alert staff as soon as possible if you identify an error in a prior calculation. Next, a brief note on who must certify the form. Form 13502F4 must be certified by a director or senior officer, the CCO, the CEO, CFO, or COO. Regardless of who signs, we will typically reach out to the CCO if we have questions during a review. It's therefore important that the CCO and certifying officer have full visibility into the numbers inputted and the supporting records. Please note that though this slide only mentions Form 13502F4, for firms registered solely under the Commodity Futures Act and complete Form 13503F1, the same certification requirements apply. Now, after certifying the form and entering contact details about your firm, you'll be asked to select the firm's membership status in Part 3. Selecting the correct option here is important so that the correct version of the form is generated for your firm to complete. In the most common scenario, registrant firms and unregistered capital markets participants who are not also CIRO members will select either all other firms or unregistered IFM only, if applicable. If your firm is both a CIRO member and registered in another category, for example, also an IFM, select either MFDA or IROC membership. There is no difference between the forms generated by these two options. Though we recognize the references to IROC and MFDA are outdated, please note that per OSC recognition order effective June 1st, 2023, all references to IROC and MFDA in Rule 13502 and 13503 and the fee forms should be interpreted as references to CIRO. For today's walkthrough, we'll proceed from the perspective of a registered IFM that is not a CIRO member, as this is the most common fee-paying profile we see. With that selection made, we need to anchor the fee calculation to the correct designated financial year. Under the previous fee rules, firms whose audited financial statements were not available at the filing due date could calculate their fees using an estimate of their full year revenues and then subsequently adjust the fee once the final audited financial information became available. Effective April 3rd, 2023, however, all firms must now calculate their participation fee using their designated financial year. That is, the most recently completed financial year determined at the time of filing for which audited annual financial statements are available if your firm is a non-CIRO member, or the audited annual Form 1 available if your firm is a CIRO member. Only in very limited cases would a firm select no to the designated financial year question. An example may be a newly incorporated and registered firm that does not yet have audited annual financial statements for a completed year because its first financial year ends close to or after the filing deadline of November 2nd. A firm in this case would generally not have a designated financial year at the time of filing. Now, we appreciate this is a lot of information to take at once, so let's look at an example of a correct filing to confirm our understanding. If we assume a registered IFM with a December 31st year end is preparing to submit its filing before the F4 deadline of November 2nd, 2025, the designated financial year in this case would be December 31st, 2024, because it is the most recently completed year for which audited financial statements are available at the time of filing. Practically speaking, this means that the IFM should base its participation fee calculation on its annual audited financial statements as at December 31st, 2024, and that all financial data used to populate the filing should be sourced from the same designated financial year of December 31st, 2024. We should note that only unregistered capital market participants may use unaudited annual financial statements to calculate their fees, and only if they do not ordinarily have their annual financial statements audited. Now that we know what a correct filing looks like, here's an example of an incorrect filing and the related errors we see most often. Assuming the exact same fact set as the correct filing in the previous slide, we can see that selecting December 31st, 2025 as the designated financial year would clearly be incorrect. December 31st, 2025 would not be the firm's most recently completed financial year at the time of filing before the deadline of November 2nd, 2025. And its audited financial statements as at December 31st, 2025 would similarly not be available at that time. This type of incorrect filing of selecting a designated financial year that ends after the November 2nd deadline is what we see most often and is frequently combined with the additional error of using an estimate of full year financial results to calculate participation fees instead of actual results. Using the wrong designated financial year can lead to an incorrect fee being paid, and if an underpayment is later identified, late fees may apply in addition to the amount underpaid. Please carefully review the designated financial year definition in Rule 13502 and ensure that the correct designated financial year is used when you file. Now, with the designated financial year set, let's move line by line through the form, starting with line 1, total gross revenues. Line 1 captures your total gross revenue for the designated financial year on a global basis. For registrants, this figure should agree to the sum of all gross revenues reported on your audited annual financial statements for the designated financial year, or the total revenue line on Statement E of your audited annual Form 1, if your firm is a CIRA member. For unregistered capital markets participants who do not ordinarily have their financial statements audited, the figure may be taken from your unaudited annual financial statements used for the designated financial year. Two important points to mention when entering an amount in this line. Net revenues should be adjusted to reflect gross revenues, and all amounts should be reported using whole numbers and not in thousands. Here are some of the common reporting errors we see on line 1 and what should be reported instead. As we've already noted, all amounts should be reported using whole numbers. However, we continue to see some firms still reporting in thousands. For example, reporting 1,000 when they meant 1 million. Some firms are only reporting their total gross revenues in Ontario instead of their global total gross revenue
for the designated financial year. Please keep in mind that the firm's specified Ontario revenue is only isolated later in the calculation. It's not appropriate to do so in line 1. Finally, we note some firms are incorrectly converting non-Canadian dollar amounts using an average annual exchange rate or an internally derived rate. Firms should instead use the daily exchange rate for the last business day preceding your designated financial year-end date as posted on the Bank of Canada website. Reporting the correct global gross revenue in line 1 is important because it flows into the rest of the calculation and may result in an underpayment of fees if done incorrectly. Now let's look at what deductions are permitted, beginning with line 2, revenues not attributable to capital markets activities.
Line 2 permits firms to deduct revenues that are not attributable to capital markets activities. The key to understanding what revenues are eligible to be deducted in this line requires careful consideration of how capital markets activities are defined in the fee rule. Capital markets activities include those for which registration is required or for which an exemption from registration is required under the Act or the Commodity Futures Act, or would be required if those activities were carried on in Ontario. Keeping this definition in mind, your firm should assess whether the revenues you plan to deduct in line 2 were generated through capital markets activities or not. Our expectation is that this assessment should be supported by a comprehensive analysis that references the appropriate legislative guidance and should be readily available upon staff's request. In terms of the errors we see most often on line 2, some firms are deducting revenue based on where it was earned, such as deducting revenue because it was earned outside Ontario. This is not a valid basis, as revenue should only be deducted based on whether it is attributable to capital markets activities or not, regardless of where it was earned. Some firms are deducting revenue that is related to activities requiring registration or an exemption from registration. Line 2 only permits revenues to be deducted if they are not related to activities requiring registration or an exemption. Beyond line 2, the form provides other specific enumerated deductions on lines 3 to 6. Lines 3 and 4 deal with revenues earned by a firm that may be deducted under certain conditions, whereas lines 5 and 6 deal with expenses incurred by a firm that may be deducted under certain conditions. We'd like to emphasize that these deductions are narrowly defined with specific eligibility criteria and are only available to the extent the amount to be deducted is already included in line 1. With that broad overview provided, let's look more closely at the deductions in line 3 and 4. For line 3, firms may deduct redemption fee revenue earned when investment fund securities sold on a deferred sales charge basis are redeemed, provided it was earned in the designated financial year. For line 4, firms may deduct administration fee revenue only where it represents a reasonable recovery of operating expenses that the firm paid on behalf of the funds it manages. The number of firms making use of the deduction under line 3 compared to line 4 is relatively small, and so the common errors we primarily observe between the two is within line 4. We've seen some firms attempting to deduct most or all of their operating expenses or management fees as administration fee revenue. As we noted in the previous slide, the deduction under line 4 relates exclusively to administration fee revenues, not expenses, and only those administration fee revenues that meet the specific definition. An important point to keep in mind here is that the revenues deducted should only be those earned to recover expenses belonging to the managed funds, but were paid by your firm on the fund's behalf. Management fees or other fees that are earned for providing registrable activities should not be deducted. Now to lines 5 and 6, which address deductible amounts paid to other firms. For line 5, firms can deduct advisory or sub-advisory fees paid to a registrant firm or an unregistered exempt international firm, but only if those amounts were already included in line 1. For line 6, firms can deduct the trailing commissions paid to a registrant firm or an unregistered exempt international firm, but again, only if those amounts were already included in line 1. These deductions generally help to avoid the double counting of revenue in scenarios where the trailer or advisory fee recipient is itself reporting the fees as revenue in its own filing. For both lines, we've observed that firms typically make the same type of errors. Specifically, some firms are deducting either trailer or advisory fees paid to firms that were neither registrant firms nor unregistered exempt international firms. Firms must ensure that the fees deducted are only paid to eligible firms and have appropriate documentation evidencing this upon staff's request. Finally, we'll discuss line 9, where the Ontario percentage is determined. So, if we think of the deductions as a series of filters that's applied to your firm's total global revenues in line 1, what should be left over at this point is what's called revenue subject to participation fees, or line 8. Applying the Ontario percentage to this amount is the final filter that isolates the portion of your firm's total revenues that is attributable to capital markets activities in Ontario, or, in other words, your specified Ontario revenues. As we noted in slide 5, the firm's specified Ontario revenues are what's used to determine the applicable fee tier in Appendix C and the participation fee payable. Using the correct Ontario percentage is essential in determining the correct amount of fees payable, and so we'll spend some time in the next few slides walking through a practical approach on how to calculate it correctly. Determining the firm's Ontario percentage is a multi-step process that begins with assessing where its permanent establishments are located. We should note that permanent establishment is a Canadian Revenue Agency defined term, and so firms should refer to the relevant Canadian federal tax regulations or consult their tax advisors when making this assessment. Once this has been done, firms should then consider the results of this assessment as they review the definition of the Ontario percentage and decide which of the 3 paragraphs of the definition are applicable to them. As we'll see from the next slide, where the firm's permanent establishments are located directly affects which of the prescribed methodologies of calculating the Ontario percentage should be used, and so it's important that this step is completed accurately. Paragraphs A, B, and C of the definition of the Ontario percentage outlined on this slide contemplate 3 different scenarios of where the firm's permanent establishments are located, with each scenario prescribing a specific methodology to calculate the percentage. In general, the 3 scenarios and methodologies include: A, where the firm only has a permanent establishment in Ontario. In this case, the Ontario percentage is automatically 100%. B, where the firm has a permanent establishment in Ontario and elsewhere. In this case, the Ontario percentage would be the percentage of the firm's total taxable income attributable to Ontario, typically determined with reference to Schedule 5 of the firm's Canadian federal tax return. And C, where the firm has no permanent establishment in Ontario. In this case, the Ontario percentage would be the percentage of your firm's total revenue attributable to capital markets activities in Ontario, typically calculated as the percentage of your firm's total revenues earned from Ontario clients. Our suggested waterfall approach for firms to arrive at the correct methodology is to review each paragraph starting with A and to check one by one which paragraph is applicable based on the locations of its permanent establishments. To illustrate this approach, we've produced a decision tree in the next slide that can be used as a practical visual aid on how to determine the firm's Ontario percentage correctly. Beginning at the top of the tree from the start bubble, firms should make their way down, following the corresponding arrows as they answer each of the question bubbles until they reach a decision bubble that indicates which methodology to use. As an example, let's assume the registered IFM from our previous examples assessed it had permanent establishments in Ontario and Quebec during the designated financial year. The firm would begin by answering question 1 at the top of the tree. Did the firm have a permanent establishment in Ontario during the designated financial year and no permanent establishments elsewhere? Since the answer is clearly no, as it had a permanent establishment in Ontario and Quebec, the firm would follow the no arrow and proceed to answering question 2, and so on and so forth. We would strongly encourage firms to use this tool as we think it could help firms avoid some of the common errors we've observed in the past. For example, some firms are using the wrong methodology to calculate their Ontario percentage that is inconsistent with where their permanent establishments are located. For example, they may have a permanent establishment in Ontario only, but have calculated their Ontario percentage as the percentage of their total revenues per paragraph C, instead of automatically using 100% per paragraph A. There are also firms using an alternative basis to calculate the Ontario percentage, instead of what is specified in the applicable paragraph. Basing the calculation on the number of Ontario clients as opposed to using total revenues when applying paragraph C would be an example of this type of error. The difference in fees between using the various methodologies to calculate the Ontario percentage can be significant, and so we'd strongly recommend that firms please carefully assess where their permanent establishments are located, review the 3 paragraphs of the Ontario percentage definition, and utilize the decision tree when completing line 9. Now, switching gears here a bit, much of the guidance we've shared in this presentation up till now is informed by the findings of the participation fee desk reviews we've performed periodically. And as noted in the second bullet point of this slide, using these findings for this purpose is one of the main objectives of the participation fee desk reviews, including the most recent 2025 desk review completed of the previous fee cycle. For the 2025 desk review, out of more than 3,300 submissions, staff selected a sample of participation fee calculations submitted and requested supporting documentation to review the calculations. We visually represented the results of the review in the chart where we can see the distribution of errors observed by staff. The 3 most common errors identified were related to the Ontario percentage being calculated incorrectly, followed by inappropriate line 2 deductions, or incorrect designated financial years being used. Since we covered all these topics in today's session, the chart could be used as a useful reminder of which areas of the fee calculation firms may wish to place additional focus on when completing them. To close off this topic for today, we wanted to briefly outline our expectations when firms are selected for review, as well as where additional resources on this topic may be found. When selected for review, our expectation is that firms should be able to readily provide the appropriate books and records to support each line item in Form 13502F4 or 13503F1. We also think it's important to point out that the supporting information provided by the firm should be sufficiently detailed for staff to understand the firm's position for a given line item, particularly for line items that require a more comprehensive analysis, such as the deduction under line 2. Providing this detail when responding to the initial information request can help minimize the amount of follow-up required and time to complete the review. For additional resources, firms can find the fee rule, the form, and the companion policy on the OSC website in the links provided. The staff notices noted on this slide also provide practical commentary on recurring issues from our reviews, which firms may find useful referring to when completing their calculations. Thank you for your time, and at this point, I'll pass it to George, who will speak to the excess working capital filings.
Thank you, David. In the next section of the presentation, I'm going to provide an overview of the working capital requirements, discuss some common deficiencies and best practices staff have identified during compliance examinations, and the action the OSC may take if a registrant is capital deficient. As a reminder, please submit your questions as they come to you using the question function in the GoToWebinar control panel instead of waiting until the end of the presentation. The minimum working capital requirements for registered firms are set out in Section 12.1 of National Instrument 31103. Specifically, registered advisors are subject to a $25,000 minimum capital requirement. Registered dealers are subject to a $50,000 requirement, and registered investment fund managers are subject to a $100,000 requirement. These requirements are not cumulative, meaning where a firm is registered in more than one category of registration, the minimum capital required is the highest amount applicable to the firm's registration categories. So, for example, if a firm is registered as both a dealer and investment fund manager, the minimum required capital is $100,000 rather than the combined amount of $150,000. These requirements generally do not apply to firms that are members of CIRO that are subject to alternative capital requirements. The companion policy to National Instrument 31103 provides guidance for determining the appropriate frequency for a firm to calculate its working capital position. The guidance makes it clear that registered firms should always be aware of their working capital position. Further, where a firm has determined that their excess working capital position has dropped below zero, they must notify the regulator as soon as possible. In determining the exact frequency for performing ongoing working capital calculations, there is no clear-cut rule. Rather, factors such as the size of the firm, the nature of its business, and the stability of the components of its working capital should be considered. For example, a firm that has working capital levels that fluctuate widely and whose business is unpredictable should perform calculations more frequently than a firm whose working capital levels stay relatively consistent. Last but not least, it is very important that appropriate documentation is maintained to evidence each working capital calculation, including information about who prepared and reviewed each calculation. Form 31103F1, which can be found in National Instrument 31103, sets out instructions that registered firms should carefully follow when calculating their excess working capital. First and foremost, the financial information used in the calculation must be based on the firm's financial statements, which have been prepared using accounting principles used to prepare financial statements in accordance with National Instrument 52107. In most cases, this would require the financial statements to be prepared in accordance with International Financial Reporting Standards, or IFRS. Second, Form 31103F1 should be signed and dated by two officers or directors to evidence that they have examined the capital calculation and certify that the firm is in compliance with the capital requirements. As I noted on the last slide, if at any time the excess working capital is less than zero, the firm must notify the regulator as soon as possible. Next, I'll go over some considerations specific to each line item of Form 31103F1. Line 1 generally will include all current assets that have been recognized as such on the financial statements and as defined in International Accounting Standard 1, or IAS 1. Non-current assets such as property, plant, and equipment, intangible assets, or restricted cash should not be included on line 1. Line 2 is meant to capture any current assets that were included on line 1 but in practice cannot be converted into cash in a prompt and timely manner. Examples may include prepaid expenses, related party receivables, and cash committed to serve a specific purpose, but the determination depends on the nature of each item and all relevant circumstances. Line 3 reflects the adjusted current assets and is calculated by subtracting the total on line 2 from line 1. Similar to line 1, line 4 generally will include all current liabilities that have been recognized as such on the financial statements and as defined in IAS 1. Non-current liabilities such as long-term deferred revenue, long-term debt, or deferred employee compensation should not be included on line 4. Line 5 is meant to capture and include any long-term related party debt. For this debt to not be included, the firm and the lender must have an executed subordination agreement, and the agreement must be in the form set out in Appendix B of National Instrument 31103, and a copy must be delivered to the regulator. If the firm does not have a subordination agreement or does not comply with the form set out in Appendix B, or has not delivered a copy to the regulator, 100% of the non-current related party debt must be included on line 5. Line 6 reflects the adjusted current liabilities and is calculated by adding line 4 and line 5. Line 7 reflects the adjusted working capital and is calculated by subtracting line 6 from line 3, which was the adjusted current assets balance. Line 8 reflects the minimum capital that is applicable depending on the firm's registration category. Line 9 adjusts the firm's working capital to reflect the risk of not being able to realize the full value of the securities it holds when liquidating them. Schedule 1 to Form 31103F1 sets out specific margin rates for each type of security, with higher risk securities requiring higher margin rates. Line 10 adjusts the firm's working capital to reflect the amount of the deductible that will not be covered by the firm's bonding or insurance policy in the event of a claim. Line 11 adjusts the firm's working capital for firms that are guaranteeing the liability of another party as there is a risk that if the guarantee was called upon, the firm may not be able to meet all of its obligations. The total amount of the guarantee must be included in the capital calculation unless the amount is already included in the firm's statement of financial position as a current liability and has already been reflected on line 4 of Form 31103F1. Last, line 12 adjusts the firm's working capital for any unresolved differences that could result in a loss from either firm or client assets, including unresolved differences relating to client securities, registrant's investments, or shortfalls in cash. Next, I'm going to discuss some common deficiencies and best practices staff have identified during compliance examinations. We have flagged and provided guidance for all deficiencies I'm going to discuss in multiple RIE division summary reports over the years. The first common deficiency relates to related party receivables. Specifically, our reviews of Form 31103F1 identified a number of firms that included related party receivables as current assets on line 1. This practice is not appropriate unless the receivable meets the definition of current asset as per IAS 1, is recoverable and there are indicators that the amount will be collected, and is readily convertible to cash. In our reviews, we noted that firms did not maintain adequate evidence that these conditions were met. In particular, some firms did not demonstrate that the receivable met the definition of a current asset as there was little or no collection of the receivable amount. When a related party receivable is included in current assets, the receivable should be collected within 12 months. In other cases, we noted that firms did not maintain evidence that the receivable was readily convertible to cash. In our view, unless the receivable can be converted to cash easily, promptly, and without difficulty, it should be included on line 2 of Form 31103F1 and excluded from excess working capital. We also observed instances of repayments by the related party to the firm, which were subsequently followed by additional, sometimes larger, advances to the related party. In our view, the economic substance of these transactions was that the loan obligation was not settled and the receivable remained uncollected. Frequently recurring transactions of this nature, or a firm acting as a line of credit for related parties, raises regulatory concerns and suggests that it is not appropriate to include the receivable in the firm's excess working capital. In order to include related party receivables as current assets on line 1, firms should document the terms of any related party receivable, for example, the parties involved, the interest rate, and the repayment terms. Firms should also reevaluate the classification at each reporting period and retain documentation of this reevaluation. Further, firms should also reassess and retain documentation on the financial viability and solvency of the related party to support whether the receivable is collectible. And last but not least, firms should reevaluate and retain documentation to support whether the related party receivable can be readily convertible to cash. Another common deficiency we raise is firms not performing their working capital calculations with sufficient frequency. This raises concerns that firms were not aware of their working capital position at all times. As I mentioned earlier in the presentation, there is no clear-cut rule for how frequently a firm should perform their working capital calculations. Rather, factors such as the size of the firm, the nature of its business, and the stability of the components of its working capital should be considered. The next common deficiency we raise is firms using financial information in preparing Form 31103F1 that is not prepared in accordance with the required accounting principles. For example, we see some firms using the cash basis accounting method instead of the accrual basis accounting method, resulting in non-compliance. Firms are required to comply with the applicable accounting principles as defined in National Instrument 52107, which is IFRS for most registered firms. Another common deficiency we raise is firms failing to adequately monitor the firm's working capital position by not maintaining accounting records and/or evidence of the working capital calculations. When we conduct our compliance examinations, we expect that appropriate documentation will be available for us to review that evidences the working capital calculations conducted, including information about who prepared and who reviewed each calculation. Last but not least, we find that some firms do not carefully follow the instructions set out in Form 31103F1 and thereby incorrectly calculate the firm's working capital position. For example, some firms do not add 100% of the long-term related party debt on line 5, despite not meeting the conditions required for subordination agreements. It is important that registered firms carefully review the instructions set out in Form 31103F1 to ensure the firm's working capital position is calculated correctly. Where firms are capital deficient and/or late in submitting the required filings, they may be subject to regulatory action, including issuance of a warning letter, levy of late fees, terms and conditions imposed on the firm's registration, and potentially a full suspension of the firm's registration. The action the OSC takes is determined on a case-by-case basis, and firms can exercise an opportunity to be heard under Section 31 of the Securities Act before the director imposes terms and conditions or suspension. As I have mentioned numerous times, when a firm has determined it is capital deficient, it must notify the regulator as soon as possible. Potential actions a firm can take to resolve a capital deficiency include injecting cash into the firm in return for equity, or borrowing from a related party and entering into a subordination agreement with the related party for the long-term portion of the amount borrowed. Firms should be prepared to provide the OSC with documentation to support the actions taken. For example, a firm may provide a bank statement to support any cash injections, an executed subordination agreement for any long-term related party debt, updated interim financial information, and an accompanying updated Form 31103F1. With the introduction of OSC Rule 11501, registered firms are required to file certain documents electronically using the OSC's filing portal. This includes Form 31103F1, as well as other filings I'll discuss shortly. The page is accessible using the link on the slide, and if you have any questions, please don't hesitate to reach out to the OSC's Inquiries and Contact Center using the contact information on the slide. If you call, please know that the working hours are 8:30 a.m. to 5 p.m. Eastern Standard Time. As I mentioned, there are other filing requirements that I will briefly touch on. All registered firms are required to provide annual financial statements and may also be required to deliver interim financial information depending on their category of registration. Where a firm has executed a subordination agreement, it must notify the regulator 10 days before it repays the loan or any part of the loan or terminates the agreement. Likewise, for insurance policies, a firm must notify the regulator in writing of any change in, claim made under, or cancellation of any insurance policy. Last, as Rachel will discuss in the next section, NAV adjustments must be delivered to the regulator when there has been a material error and the NAV per unit does not accurately reflect the actual NAV per unit at the time of computation. This slide includes a list of resources, and I would particularly encourage firms to review the OSC's topical guide for registrants, as it covers a wide range of topics and is easy to navigate and search by topics or keywords. Next, I'll pass it over to Rachel to discuss NAV adjustment reporting.
Thank you, George. I will now be presenting on the topic of NAV adjustment reporting. As this is the last topic in our outreach session today, we encourage you to submit your questions in advance instead of waiting for the Q&A session at the end. Here's what I'll be covering. We'll begin with an overview of the NAV adjustment reporting requirements. Next, I'll highlight some of the common causes of NAV errors that we've observed. Then we'll walk through the Form 31103 F4. I will refer to Form F4 throughout the presentation. After that, we'll identify the common areas that typically require follow-up during our reviews. Finally, we will conclude by summarizing the responsibilities of investment fund managers, IFMs, and we will also outline the key actions IFMs should take to ensure accurate NAV adjustment reporting. Under Section 12.14 of National Instrument 31103 and the related companion policy, IFMs are required to submit a completed Form F4 Net Asset Value Adjustments whenever a NAV adjustment has been made. A NAV adjustment is required when a material error causes the NAV per unit to not accurately reflect the actual value at the time of calculation. We expect IFMs to have clear policies that define what constitutes a material error. This includes setting appropriate threshold levels and specifying procedures for identifying and correcting such errors. We expect firms to submit Form F4 on a timely basis within 30 days after the end of the first, second, and third quarter, and within 90 days after the year-end reporting on any NAV adjustment. Now, let's take a look at some of the most common causes of NAV adjustments that we saw during our reviews. In general, we see errors made by third-party fund administrators. These include incorrect pricing errors or incorrect income and expense accruals. Second, there are control failures within the firm itself. Examples include incorrect security setup in the firm's system, trading errors, and use of outdated pricing files. Third, we've seen issues related to the mispricing of illiquid or hard-to-value securities. Another common cause is the incorrect recording of corporate actions. For instance, duplicating a stock split transaction can lead to an overstated number of shares and consequently an overstated NAV. Another common cause is due to human errors. This includes inputting incorrect values, incorrect accounting between different fund classes and series, especially when they are in different currencies. Over the past 2 years, we've observed that the most common causes of NAV adjustments have been related to incorrect security pricing. This includes inaccurate or delayed price data from third-party fund administrators, as well as mispricing that results from corporate actions. In addition to pricing errors, control failures within firms have also contributed to NAV errors. This includes duplicated transactions, incorrect exchange rates, and manual accounting mistakes. Let's now take a closer look at Form F4. The form consists of 24 questions, which I'll review at a high level. To make it easier to follow, I've grouped the questions into 6 key categories based on their purpose and content. The first category is general information. This section captures the name of the IFM and the investment funds affected by the NAV adjustment. The second category is dates. Here, we record the date the NAV error occurred, the date it was discovered, and the date the adjustment was made. These dates are critical for assessing whether the IFM has effective controls in place to identify and correct errors in a timely manner. The third category is NAV and adjustment amount. On lines 6 to 11, you report the original total NAV, original and revised NAV per unit, the NAV error as a percentage of the original NAV, the total dollar amount of the NAV adjustment, and the effect, if any, of the NAV adjustment per unit. Next category is reimbursement. Lines 12 and 14 ask for the total amount reimbursed to unit holders and to the investment fund. Lines 13 and 15 capture the dates when those reimbursements were made. Next category is description of the error and controls in place. And this is a very important section. Line 16 requires a clear explanation of the cause of the NAV error. Lines 17 and 18 ask who discovered the error, whether it was the IFM or another party. Line 19 is whether the error was considered material based on the firm's policies and procedures. As mentioned earlier, we expect IFMs to have clear definitions of what constitutes a material error in the policies and procedures. Line 20, firms confirm whether the policies were updated as a result of the error. Line 21 is about the descriptions of the controls implemented to prevent recurrence. If no updates were made to policies and procedures, we expect firms to explain why changes were not needed on line 22. Finally, the last category is communications to unit holders. We want to know whether the firm has issued communications to unit holders as a result of the NAV adjustment. There are 6 common areas that we typically follow up with IFMs when reviewing Form F4 submissions. Let me walk you through each one. Dates, lines 4 and 5. We start by looking at the dates the NAV error was discovered and corrected. If there is a significant delay between when the error occurred and when it was adjusted, it may suggest weak internal controls or that the error remained unresolved for too long. In those cases, we follow up to understand the reason for the delay. Reimbursement, lines 12 to 15. These lines should clearly indicate whether reimbursement was made to unit holders or to the investment fund, along with the dates of those reimbursements. Many times, these lines were left blank. Even if no reimbursement was necessary, for example, if the NAV was overvalued for a short period of time and no purchases were made, we still expect firms to provide a brief explanation rather than leaving these lines empty. Description of the cause of the error, line 16. We follow up when the description of the cause of the error is unclear, vague, or insufficient. We expect IFMs to provide a clear and detailed description of what caused the error. Context of error and controls in place, lines 17 and 18. Line 17 asks whether the NAV error was identified by the IFM. If a third party discovered the error, we want to understand whether the IFM has effective controls in place that could have detected the error, and whether those controls are adequate. Policies and procedures, lines 20 to 22. If the firm indicates that no changes were made to its policies and procedures following a material NAV error, we follow up to understand why. When updates were made, they should be clearly explained, and the corrective actions must be appropriate and sufficient to prevent recurrence. Communications to unit holders, lines 23 and 24. When the error is material and persists over time, we expect firms to document when and how they communicate with unit holders, and this should be clearly outlined in their policies. Let's now conclude by summarizing what IFMs should be doing to ensure proper NAV adjustment reporting. First, IFMs must maintain and apply written policies and procedures to ensure that the fund's investments are properly valued and that the NAV is accurately calculated. This is the cornerstone of effective NAV reporting. Second, IFMs must have robust policies and procedures in place to identify and correct NAV calculation errors. This should include a reasonable materiality threshold to determine when an adjustment is necessary, a clear process for how NAV errors will be rectified, and a framework to ensure that both the fund and its unit holders are made whole if the NAV has been materially overstated or understated. Third, in the event of a NAV adjustment, IFMs must submit Form F4 to the principal regulator within the required timeframe. Fourth, IFMs must ensure the fund's NAV is adjusted appropriately, and the compensation is provided to the fund and its unit holders when necessary. Fifth, it's important to assess the control failure that led to the incorrect NAV and take steps to enhance internal controls to prevent similar issues from occurring in the future. And finally, IFMs must adequately oversee any service providers involved in NAV calculations to ensure both accuracy and accountability. In summary, by implementing strong policies, promptly correcting errors, and ensuring proper oversight of service providers, IFMs can significantly strengthen the NAV adjustment reporting process. For additional resources on NAV adjustment reporting, I would like to highlight OSC Staff Notices 33752 and 33759. These notices provide detailed summaries of NAV reviews conducted in 2020 and 2024, which provide valuable insights into best practices. They also explain the rationale behind regulatory follow-ups with firms and clearly set out our expectations for IFMs regarding NAV adjustment reporting. With that, I'll now turn it back over to Matthew.
Thank you to our presenters. We are now in the Q&A portion of the seminar. We will now take a 5-minute break to give our presenters a chance to review the questions that have come in. Thank you.